On a Thursday afternoon in January of 2026, silver touched a price almost nobody in the market had modeled for. It hit a record above $120 an ounce. And then, in less than 24 hours, it lost more than a quarter of its value. Not in a week, not in a month, in a single trading day. It was the worst one-day collapse in silver since March of 1980. If you were watching your portfolio that Friday, you understand exactly what unthinkable means in this market. By the end of this video, you will understand exactly what triggered that move, why it was tied directly to a decision coming out of the White House, and why, just this week, Jamie Dimon, the CEO of the largest bank in America, stood in front of cameras and said the quiet part out loud about the risk still sitting underneath this market. Quick note before we go further, this video is for education only. Nothing here is a recommendation to buy or sell anything. Think of this as a briefing, not advice, and use it to sharpen your own judgment. To understand why that crash felt so unthinkable, you have to understand what came before it. For most of 2025 and into January of 2026, gold and silver were not behaving like ordinary commodities. They were behaving like a referendum on trust. Investors around the world had grown uneasy about a few things happening at once. Government debt was climbing without any credible plan to slow it down. The dollar had been drifting weaker for stretches of the year, and there was a quiet but persistent worry that the Federal Reserve, the institution responsible for keeping the value of money stable, might come under political pressure. Analysts started calling this the debasement trade. The idea is simple, even if the economics behind it are not. When people lose a little bit of confidence in paper currency and government bonds, some of that money looks for a place to sit that no central bank can print more of. Gold has played that role for centuries. Silver, because it is cheaper and more volatile, often moves even harder in the same direction, for better and for worse. By late January, silver had more than doubled over the prior year. Some of that was real investment demand. Some of it, as we now know, was pure speculation, traders piling into a moving trade because it was moving, not because they had done the underlying analysis. Then came the moment that changed everything. President Trump announced his intent to nominate Kevin Warsh, a former Federal Reserve governor known for a more hawkish, inflation-focused approach to monetary policy, as the next chair of the Federal Reserve. On the surface, that might sound like a technical personnel decision. In practice, it hit the market like a jolt of electricity. Here is why it mattered so much to precious metals specifically. Part of the rally in gold and silver had been built on a fear that the Fed's independence was eroding, and that future leadership would be pressured into cutting rates and letting inflation run hot to make government debt easier to manage. Warsh's nomination signaled almost the opposite, a chair less willing to cut prematurely, more focused on defending the currency's purchasing power. Almost instantly, the U.S. dollar spiked. And because gold and silver are priced in dollars, a stronger dollar makes them more expensive for buyers overseas, which drags demand and price down. Silver, being the more speculative and less liquid of the two metals, absorbed the shock hardest. Spot silver fell nearly 30% in a matter of hours. Futures fell even further. It was not a gradual repricing. It was a stampede for the exits, the kind of move where the people asking questions afterward almost always lost more money than the people who paid attention to the warning signs while it was happening. This is where a bit of market history becomes genuinely useful, not as trivia, but as a lesson in mechanism. The last time silver fell this violently in a single day was March of 1980, in the aftermath of the Hunt brothers' failed attempt to corner the global silver market. That earlier crash happened because an artificial leverage-driven price had detached from anything resembling underlying value, and once the exchanges changed the rules on margin requirements, the whole structure collapsed at once. The 2026 crash was different in its cause. This one was triggered by a policy signal rather than a margin call, but the lesson underneath is the same one investors relearn every generation. When a price has risen quickly on sentiment, leverage, and momentum, rather than steady accumulation, the unwind tends to be just as fast, and often faster, than the climb. That does not mean the fundamentals behind gold and silver disappeared overnight in January 2026. It means a large share of the move higher had been froth, positioning built on the assumption that the path of least resistance was straight up, and froth gets removed violently, not politely. Think about two hypothetical investors because this is where the lesson becomes personal instead of abstract. The first bought silver in the final week of January, right as headlines were calling it the trade of the decade, using money he could not really afford to lose, and watching the price climb made him add more on the way up. When the crash came, he sold near the bottom out of pure panic, turning a paper loss into a permanent one. The second investor had been buying smaller amounts steadily for the previous 2 years, treating silver as a long-term store of value rather than a trade to be timed. When the crash hit, her position dropped on paper too, but she carried no leverage, no borrowed money, and no need to sell that week to cover anything. A year from now, these two investors will likely tell very different stories about the same asset, even though they owned the exact same metal. The difference was never the metal. It was the structure underneath the decision to own it, and that distinction, patient ownership versus leveraged momentum chasing, explains more about who gets hurt in moves like this than any headline ever will. But here's what most investors missed in the weeks that followed because they were still staring at the crash instead of what came next. The story did not end with that one brutal day. Gold ground steadily lower over the following months, moving from its record high near $5,000 an ounce down toward roughly $4,000 by late June, its first sustained break below that level since the previous November. Silver's path was even rougher. It slipped toward the high 50s, essentially cutting its January peak in half. Then, in June, when President Trump claimed a ceasefire had ended hostilities with Iran, silver actually staged a sharp rally, briefly climbing back above $67, because traders read the headline as a step toward global stability. That optimism did not last. Within weeks, renewed airstrikes and a reinstated blockade in the Strait of Hormuz sent oil prices climbing again, reignited inflation worries, and pulled silver back down below $60. This is the pattern worth sitting with for a moment. Silver in 2026 has not been trading primarily on industrial demand or mine supply. It has been trading on headlines out of Washington and the Middle East, on the presumed path of interest rates, and on the strength of the dollar. That is a market being pushed by macro forces far bigger than the metal itself. And if you are holding this asset, understanding that distinction matters more than almost anything else. This is where everything connects back to Jamie Dimon. On July 21st, Dimon sat down for an interview recorded a few days earlier and delivered a warning that immediately made headlines across financial media. He said plainly that markets are underestimating the risks still facing the global economy. He pointed to the ongoing conflict in Ukraine, the unresolved tension in the Middle East, rising friction between the United States and China, and a global increase in military spending happening at the exact moment that government deficits are already expanding. He used a phrase that stuck with a lot of people. He described the risk in markets as shifting below the surface, like tectonic plates, quiet, largely invisible day to day, but capable of producing a sudden and violent event when the pressure finally releases. What made the warning land even harder is the context surrounding it. This came in the same stretch of time that J.P. Morgan and other major banks were reporting record quarterly profits. Markets were near highs. And yet the man running the largest bank in the country said he personally would not buy stocks or long-dated U.S. Treasury bonds at their current prices. He specifically said he expects yields to stay elevated, somewhere in the 4 to 4.5% range, even if inflation eventually cools back toward 2%. In plain terms, he is telling you that the cost of borrowing and the return demanded for lending the government money over the long run is not going back to where it used to be, regardless of what happens with inflation in the near term. Why does that matter so much for gold and silver investors specifically? Because precious metals sit at the intersection of two forces that are currently pulling in opposite directions, and understanding that tension is the single most useful thing you can take from this entire video. On one side, you have everything Dimon is describing: geopolitical instability, fiscal deficits that show no sign of shrinking, and a general sense that the global order is under more strain than headline stock prices reflect. Historically, that combination has been supportive for precious metals, because gold and silver are the assets people turn to when trust in government promises starts to wobble. On the other side, you have a Federal Reserve under Kevin Warsh that appears less inclined to cut rates and, based on recent policy signals, is even debating the possibility of raising them again later this year. Higher interest rates raise the opportunity cost of holding a metal that pays no yield of its own. That is the exact mechanism that hammered silver in January, and it has not gone away. So you have real structural fear pushing money toward metals and a hawkish monetary stance pulling money away from them at the same time. That push and pull is precisely why silver has been so volatile in 2026, swinging from record highs to a near 30% single-day crash to a summer rally and back down again, sometimes within the same season. So what should you actually be watching if you want to understand where this goes next, rather than just reacting to headlines the way most of the market does? Start with real interest rates, which means the nominal rate minus inflation. This single number does more to explain gold and silver's direction over time than almost any other input. When real rates are falling or negative, metals tend to do well. When real rates are rising, as they have been under the current Fed posture, metals tend to struggle, even when the geopolitical backdrop looks frightening. Second, watch the dollar index closely. Because metals are priced in dollars globally, a stronger dollar is a headwind for gold and silver, even if every other factor stays the same, and a weaker dollar is a tailwind. Third, pay attention to what the Federal Reserve actually does at its policy meetings, not what commentators predict it will do. Markets are currently split on whether the Fed holds steady or moves toward a hike later this year, and that outcome will likely matter more to silver's next major move than any single headline out of the Middle East. Fourth, and this is the one Dimon himself flagged, watch credit markets. He specifically warned about the potential for losses in leveraged lending when the next credit cycle turns, and stress in credit markets has historically been one of the more reliable early signals of broader financial trouble, often showing up before the stock market reacts at all. There is a fifth factor worth adding to that list specifically for silver, and it is one that gets far less media attention than headlines out of Washington, which is the physical supply and industrial demand picture. Silver is not only a monetary metal, it is consumed in solar panel production, electronics, and a growing list of electric vehicle and data center applications tied to the artificial intelligence build-out. Some analysts have pointed to a structural deficit between mine production and industrial consumption that exists independently of whatever the Fed decides to do with interest rates. That underlying demand does not disappear during a crash, and it does not show up on the news the way a presidential announcement does. But over a period of years, it tends to matter just as much as the macro headlines that dominate day-to-day price action. Keeping half an eye on industrial demand trends, alongside the four macro indicators already mentioned, gives you a more complete picture than watching price alone. None of this is a signal to buy or sell anything, and if any voice online, including one that sounds confident and articulate, tells you exactly what to do with your money based on a single data point, that should raise your guard rather than lower it. What Dimon's warning and the events of this year actually teach is something more useful than a trade idea. They teach you to separate a market's price action from its underlying story. Silver's crash in January was not a verdict on whether silver has long-term value. It was a verdict on how much of the January price had been built on leverage and momentum, rather than patient accumulation. The rally in June was not proof that peace had broken out. It was a market reading a headline and repricing quickly, only to reverse when the headline did not hold. The record profits at major banks this summer are not proof that risk has disappeared. They are proof that risk has not yet arrived, which, according to the man running one of those banks, is a very different thing. If there is one idea worth carrying away from everything we have covered, it is this. The market rarely tells you it is dangerous in a way that is comfortable to hear. It tends to look calm right up until it is not, and the investors who do well over long periods are usually the ones who kept paying attention to the underlying mechanics, real rates, currency strength, credit conditions, and policy direction, rather than chasing whatever the headline of the week happened to be. Silver went from a record high to its worst single-day crash in over 4 decades in less time than it takes to plan a vacation. That is not a reason to panic. It is a reason to understand the machine well enough that the next unthinkable move does not catch you off guard. If this breakdown helped you make sense of what has actually been driving gold and silver in 2026, take a moment to like this video and subscribe to Gold and Silver Analysts. It genuinely helps this channel keep producing research like this, and I would like to hear from you directly. Do you think Jamie Dimon's warning is the market finally catching up to reality, or is this the kind of caution that gets repeated every year regardless of what actually happens next? Leave your take in the comments. I read them, and some of the sharpest perspective on this channel comes from that conversation. Thanks for watching, and I will see you in the next one.